Hello guys, and welcome to our last session of today, which is chapter number 24, Flexible Budgets and Standard Costs. So on this chapter, we're going to finish our discussion, we're going to finish our course, and I hope you enjoyed it. You learned at least some basics of finance, and I will be very happy if you're going to use it in your real life and adapt it to your real life situations. So what is today's chapter is about? Today's chapter is about how to find out and construct the not budgets, but all the constructed budgets, how to compare them with actual results to find out variances. So how well we budgeted our financial numbers and to compare them with actual results. And on the second part of the chapter, we're going to talk about the standard costs. Okay? So here, as you know already, I made a red color on the topics which we're not going to cover from this chapter. So only what we're going to cover will be conceptual parts C1 and C2 and procedural parts C1 and P1, and P2. Okay, so let's start. So what is fixed and flexible budgets? So in general, in finance, we are using a lot of budgeting. Why we do budgeting? Budgeting is very important for you as well, because even if you are not doing or working in finance and you just want to know how much income do you have during the year and how much outcome you have during the year or months, you will know your budget. Let's say we all more or less plan our budget to meet some financial goals and objectives. For example, I might plan to buy a house, I might plan to go for vacation, so I need to create my budget to find out if I have enough money left in order to cover my expenses. So that's called master budget in general, and master budget is always based on a predicted level of activity for the budgeted period, which means that in master budget we know around how much activity we are planning to sell and have costs, and after we're going to compare them to real results. We have two approaches, fixed and flexible budgeting. We're going to talk about it a bit later. A fixed budget, or often it's called static budget, is based on a single predicted amount of sales, which means that only we are assuming we are selling one kind of one kind of activity, let's say, for example, 10,000 goods or 20,000 goods. So one number only of sold activities. A flexible budget tells you which is a variable budget based on different amount of sales. For example, what happens if I sell 10,000? What happens if I sell 15,000? What happens if I sell 20,000, for example? So that's the main difference between fixed and the flexible budget. But as I told you, we're going to see in practice how it works. So here you have a fixed budget, and it's called fixed budget performance report. So as I told you before, fixed budget is based on a single predicted amount of sales, which means that here we are assuming that I'm going to sell 10,000 units of goods. But unfortunately, what is happening very often, our fixed budget results are not equal to actual budget results, which means that there is a variances. So I was planning to sell 10,000 units, but I sold 12,000 units. Somehow it's good because you sold more, but the problem is that we can't really compare your fixed budget to actual budget because you have numbers for 10,000 and your actual numbers are for 12,000. So it's a bit same theory to compare apple to banana instead of comparing apple to apple, okay? Why? Because when I sold 10,000 units, of course, my sales result will be different than when I sold my units in 12,000 number. So that's why it's difficult and not very useful, but we still need to understand, in order to understand basics of fixed and flexible budgeting, we need to understand how it works. For example, we're going to go step by step. First, in sales, what is important? I was expecting to sell $100,000, but I sold $125,000. So the difference between them, which is actual result minus fixed budget, is your variance. Okay, so 125,000 minus 100,000 is 25,000 favorable, which means you were expecting to sell 100, you sold 105, so you have $25,000 of favorable variance. So you have more $25,000. What about costs? What are main costs for a company? First of all, biggest cost is cost of goods sold, which is direct materials, direct labor, and the overhead. If you want to have a look on direct materials, direct labor, and overhead, you're going to find out that, for example, direct materials, we were expecting to have 10,000, but we have a 13,000. Direct labor, we were expecting to have 15,000, but we have 20,000. So in this case, they are unfavorable because your cost is more than you were expecting. Once again, actual result minus budgetary result is your variance. But it doesn't mean it's a bad, because logically, more you sell, more cost you have, right? Because if I sold 1 bottle of water or 2 bottles of water, I have to use more direct material, more direct labor, and more overhead. So that's why this unfavorable result, which is 3,000 and 5,000, they doesn't mean they are bad. It just means we used more resources than we were previewing to use, okay? And then we have an overhead also, where you have also variance, which is unfavorable because we used more utilities and more factory supplies. Why depreciation expense and supervisory salary stays the same? Because normal depreciation, we use straight line method, and it doesn't change per year, even if we're going to produce 10,000 or 12,000 units. And also supervisor salary, because salaries are fixed cost, they don't change normally, they are also zero variance. After we have selling expenses, of course, more you sell, your selling expenses are increasing more. So that's why you see it's 10,800 and 4,300 instead of 9,000 and 4,000. So you have 1,800 and 300 variance, unfavorable. And then you have general and administrative expenses, where you have a 200 variance for office supplies, unfavorable, and 200 variance for insurance expense, unfavorable. So finally, what we're going to measure is your sales, which is 25,000 favorable, minus total expenses 11,600 unfavorable, will be your income from operations 13,400. Or other way, if you know income from your operations, which you were expecting to be 12,000, and now you're expecting it, and now you got actual result is 25,400. So difference between 25,000 and 25,400 and 12,000 will be 13,400. So finally, even if your sales are higher and your costs increased as well, finally you have 13,400 favorable. This is good analysis, but there is one problem. As I told you, the problem is that simply we are comparing apple to banana, which means that we have different unit of sales, 10,000, and the actual results are for 12,000. For this reason and for this purpose, we have another, which is called flexible budgets. So flexible budgets actually shows you your revenues, your expenses, which are very close to your actual level of activity. Normally what we do, we are preparing them for several different levels. It can be for 10,000, for 12, for 14, for 16. So it's like budgeted results, and after we're going to compare them with actual results, because finally what is our aim is to compare apple to apple or banana to banana. Okay? We're going to start preparing a flexible budget, and we're going to interpret performance report. So here, first of all, before I will show you and we discuss flexible budgets, I will remind you something from cost volume profit relationship chapter, about break-even chapter, that we have two kinds of costs, variable cost and fixed cost. So variable cost change direct proportion to activity change, which means that the more I produce, more cost I have, and fixed cost remains unchanged within the relevant range. If I pay rent for 10,000, within the relevant range, it stays same. It will be always 10,000. Doesn't matter if I'm going to produce 10,000 product, 12, 14, 16, 18, or 20. Okay? So here you have a small flexible budget, and we're going to talk about it. So what we have here in flexible budget? First of all, we have flexible budget because this information is flexible, And this information is based for 3 different activities. So we have sales, we have variable amount per unit, so which means that $10 is a predicted sales price. And what happens if I'm going to sell 10,000, 12,000, or 14,000? So if I'm going to sell 10,000, I'm going to multiply 10,000 by 10. It's going to be 100,000. Okay. If I'm going to sell 12,000, I'm going to multiply 12,000 by 10. It's going to be 120,000. If I'm going to sell 14,000, I'm going to multiply by 10 and I'm going to have 140,000. This is sales part. After I have total variable costs. So variable cost per unit, which I'm expecting to have, is 4.80. Please don't forget that these results are budgeted results, which means that that's what we are expecting. Okay, it's not real numbers, because when we do budgeting in the beginning of the year and end of the year. We are comparing actual result with budgeted result. Okay, and we have a contribution margin also, which is 5.20, which is the difference between sales price and the variable cost. So how I calculate these numbers, 48,000, 57,600, and 67,200, simply I multiply 10,000 by 4.80, 12,000 by 4.80, and 14,000 by 4.80. And then I have a contribution margin, which is difference between these two numbers. Total fixed costs, they don't change within the relevant range, because as I told you before, it doesn't matter if I'm going to produce 10,000, 12,000 or 14,000, my total fixed cost will stay the same. And my income from operations is 12,000, 22,400 and 32,800, which is difference between contribution margin and your fixed cost. Okay, so these are budgeted results, which we are budgeting for 3 different activity levels. In order, if we're going to sell 10,000, what is happening? Here is the result. In order, we're going to sell for 12,000, what's going to be my operating profit? And in order, we're going to sell 40,000, I'm going to have my operating profit. Next step is what we have to do is simply we need to analyze and compare one of them to actual results. If you remember from previous slide, the actual results we had was 12,000. 12,000 actual results are given here. And what you need to do is simply compare these actual results to budgeted results. Okay, so what is happening? We're expecting our budgeted sale will be 120,000, but actual sales are 125,000. Which means that your variance is 5,000 favorable. Now it makes more sense because we are comparing apple to apple, because we have budgeted numbers for 12,000 and we have actual numbers for 12,000. Before, in the previous slides, we had a 10,000 and 12,000, which didn't make a lot of sense. So now we are comparing 2 identical units with different price, with different variable cost. So we have a variance of 5,000 because it increased by 5,000, which is favorable because I was expecting to get 120,000, but I got 125,000. Variable cost was previewed to be 57,600, but actually now it's 59,400. So I was expecting to spend this money, but I spent 1,800 more. So it's unfavorable by 1,800. Contribution margin automatically will be difference between sales and variable cost. So I was expecting to have 62,400, but I have 65,600. So my contribution margin is favorable. And fixed cost, as you know, doesn't changes normally, but here in actually we have only 200 more fixed cost. It can be related because maybe we just paid a prime to manager, maybe something unexpected happened, so we paid more 200. So we have only variance 200 unfavorable. And finally, we were expecting to get 22,400 from operations, but we got 25,400. So which means that we got 3,000 more money. That's why 3,000 is a favorable. And we can calculate also this the second way. Your contribution margin minus fixed cost will be 3,000, or your actual results for operating profit minus budgeted results for operating profit will be 3,000 as well. So this is flexible budget performance report. So if I want to create flexible budget performance report, simply I need to understand and compare two identical number of units with different sales and with different costs. Okay, so I hope it's clear enough. Now we're gonna move to second part of this chapter, and we're gonna talk about standard costs, and we're gonna see what is the standard costs are. So standard costs we are using in order to create the flexible budgets. So we are assuming at the beginning of the year that I'm gonna have certain costs, but they are standard. So standard cost means that it's a budgeted cost more or less. So it tells you information which are based on predetermined amounts from the past. We used it for planning materials, labors, and overhead requirements. And we are expecting, this is expected numbers, what's going to happen during the year. So it's not real numbers. So what we're going to do afterwards, as you can logically understand now, we're going to compare standard costs and standard numbers to actual numbers to find out, of course, variances. Okay? So who's identifying standard costs? Standard costs are identified by managerial accountant. It can be from HR, it can be personal administrators and other people, production manager, for example. So just you to remember and pay attention that standard costs should be challenging but attainable. So if I'm going to be too much idealistic on perfectionist, I'm not going to achieve them. Okay? And what is also important, we need to take into consideration the machine breakdowns, material waste, and idle time. Okay? So these different people in the organization, they suggest and they plan different standard costs. Okay? After, we are setting standard costs for direct materials, for direct labor, and for overhead. So in this course, we're going to learn and cover variance for direct material, variance for direct labor, and variance for general overhead. Okay? Overhead variance, let's say. Because we don't go deep into variable and fixed overhead variances, it's more advanced course. And in your AT assignment, you need to calculate general overhead variance. Okay, so here we are having price standards for direct materials, and we are having quantity standards. So which means that we define the price standard and quantity standards. For direct labor, rate standard. So how much you're gonna pay, and time standard, how many hours you're gonna use. And for overhead, we have just general formula to calculate overhead variance. Let's go and see some example. The standard costs are given here. So let's consider examples that for a probe bed, which is manufacturing the bed, and you have standard costs for direct material, for direct labor, and overhead. So this company using 1 kilogram of direct material, which costs $25 per kilogram. So your standard cost for 1 unit of bed is $25. Okay. Direct labor, they use 2 labor hours to produce this product. Per hour, they pay $20 to rate, and they have direct labor rate $40. They have 2 labor hours as an overhead cost. Per hour, they cost $10. So you have a $20 of overhead costs. So final total standard cost per unit is $85, which is sum of 25, 40, and 20. What we're gonna do, we're gonna find out what's our cost variance about the company. Cost variance means that I told you about flexible budgeting. If your actual cost is more than standard cost, your variance is unfavorable. But we talk about costs. Don't get confused with sales, because in sales, if actual sales are more than standard, sales, you have a favorable. But now we are only talking about cost variances. So actually, if you have more cost than standard cost, your variance is unfavorable. And if your actual cost is less than standard cost, of course, variable is favorable because you actually used and consumed less cost than you were supposed to. So of course, your variance will be favorable. How we calculate cost volume variance? General formula is the following. Cost variance equals actual cost minus standard cost. So what is actual cost? Actual cost is actual quantity times actual price, and standard cost is standard quantity times standard price. This is general formula, and here you have definitions of each one, so which is in your book as well. So you can just simply read, for example, that actual quantity is the actual amount of the material or labor used to manufacture the actual quantity of output. So in simple way, not in book way, I will tell you that actual quantity is the quantity we use actually to manufacture products. Standard quantity is what we budgeted to use as a quantity. Actual price is what is real price, and standard price is what was budgeted price for this product. These four things you need to know in order to make variances properly. So here now what we can do, we need to differentiate price variance and quantity variance, okay, for your direct material, for example. So what's going to be price variance? This is going to be actual quantity over actual price minus actual quantity times standard price. Or quantity variance will be actual quantity over standard price and standard quantity over standard price. So this is a difference between the actual price and standard price. As you can see, actual price and standard price. And this is a difference between actual quantity and standard quantity. I know you might get confused now, but don't worry. We're going to shrink this formula and we're going to get to final version of this formula. But before, I want to show you the expanded version. So what is happening here to understand before we're going to put the final version of the formula. So if you want to calculate price variance, you need to understand the difference between price. So that's why, as you can see, actual quantity is stable. It's not moving. What is price variance? Difference between actual price, I'm going to change color, and the standard price. It's not times, sorry. Actual price and the standard price. This is what you need to understand. What about quantity variance? As you can see, standard price stays the same between these two. What is changing? Actual quantity and the standard quantity. Okay. How we calculate standard quantity? Because actual quantity will be given, actual price will be given, actual standard price will be given. What we need to calculate most of the time is standard quantity. So standard quantity will be the quantity that should have been used for the actual good. So it's important to remember the standard quantity is the quantity we were supposed to produce, use in order to produce the actual good output. But we're going to see it with an example, okay? So finally, we can, from this analysis, we can create two formulas for cost variance and for direct material variance, in specifically, which is price variance, which equals difference between actual price and standard price over actual quantity, and quantity variance is difference between actual quantity and standard quantity over standard price. Even for my off-campus students, I never oblige them to memorize this formula. These formulas you will have always access and you can check always. What I want you to understand what is inside of this formula, and in the previous slide I explained you extended definition of this formula. So this is a difference between actual price and standard price. It's a difference between actual quantity and standard quantity. Why we do it? In order to find out the quantity and the price variance. Okay. Now it's time to go to more practical work and start computing materials and labor variances before we go to overhead variance. So material and labor variances. So direct materials, we are given direct labor and total standard cost per unit. So what are direct materials? Direct materials are First of all, I'm sorry. We are considering the example of GMAX company, which makes a golf club heads with the following standard cost information. So direct material per unit is 0.lbs. lbs is a measurement system like kilograms in US, and per unit it costs 20. Per unit we need 0.5 lbs, and it costs $20 per lbs, which means that per lbs costs $20, but for 1 unit of material we are using 0.5 lbs. So 0.5 times 20 will be $10. So my direct material cost is $10. What is your direct labor cost? This is standard cost, by the way, not actual cost. So what I'm planning to do. Direct labor, we are using 1 hour per unit, and I pay $16 per hour. So my direct labor cost will be $16 because I'm using only 1 hour, and per hour I'm paying $16. So my total standard cost per unit will be $26. This is about information which is given. What we need to do now, we need to calculate variances. To calculate variances, only standard information which is given here is not enough. We need to have also actual information. I think you agree on me because we already talked that to calculate variances, we need standard cost and actual costs. So during May, GMAX produced 3,500 club heads. So this is actual information now, using 1,800 pounds of material. So actually it used 1,800 pounds of material. And GMAX paid $21 per pound for the material. This is actual cost. So from all this information, now we can start calculating variances. We're going to use this formula because here in this method, in this on this slide, sorry, it can be a bit confusing. So that's why I wrote down for you here, if you can see, the formulas from the previous slides, and why this by these numbers we can do it by ourselves, easier way, and it will be more, because here it can be a bit confusing, because when I do it with my offline students at class, they are getting confused. So I would prefer to use the second method, which is just simply formulas, and I think you will get it easier. So what was actual price? The actual price was given from previous slide was 21. What was standard price? It was given 20. So 21 minus 20 times actual quantity. What was actual quantity? 1,800 lbs. So if I'm gonna subtract 21 from 20, it's 1. 1 times 1,800 will be 1,800, which is result is here. Why it's unfavorable? Because your actual cost is more than your standard cost. So if your actual cost is more than standard cost, it means you spend more money than you are supposed to. That's why you have a price variance 1,800 unfavorable. Now we're going to do the same from quantity variance. So we're going to put actual quantity, which is 1,800. We're going to put standard quantity. As I told you, in many cases, we need to calculate standard quantity. So if we know, because it's not given standard quantity directly, so standard quantity is calculated here. So if I know I produce 3,500 units and each unit requires 0.5 lbs, so standard quantity will be 3,500 times 0.5, 1,750 lbs. So I was supposed to use 1,750 lbs, but I used 1,800 lbs. What does it mean? I used more 50 lbs, which for sure will be unfavorable variance. And I'm going to multiply it by standard price, and standard price, if you remember, was given 20. Okay, 20. I don't know if you can see it. It's a 20 here. So my quantity variance here, which we calculated 1,800 minus 1,050, which is 50 times 20, is 1,000 unfavorable. This is called materials cost variance. I hope it's clear, and if not, please ask me a question about it. And also when you're going to read book, after you're going to read book, I hope it will be also clear, but I'm trying to explain it as simplest way as possible. And normally this chapter is quite easy for most of students because once you understand the logics, then it's very easy. And as I told you, you don't need to memorize these formulas. You always just to pay attention. You use these formulas because it's easier than to do these graphs and make this, a lot of things. But personally, I think easier way will be to use these formulas, in my opinion, these two formulas. Okay. Yeah, and by the way, I forgot almost that I can calculate total material cost variance. So how I calculate them? When it's unfavorable, 1,800 and 1,000, I'm going to sum them up. It's going to be 2,800 total direct materials variance. So when it's unfavorable and unfavorable, we are adding them. So that's why it's total direct materials variance is 2,800. Imagine now, it's important by the way, if it was favorable. In that case, also I'm going to add favorable plus favorable. For example, if it was 1,800 favorable, 1,000 favorable, what I'm going to do, I'm going to add them up and it's going to be 2,800 favorable. Okay? But what happens if one side is favorable and second time is unfavorable? In that case, the biggest number absorbs the smallest number, which means that, in other words, the biggest number minus smallest number will keep this sign. For example, if in this case 1,800 was unfavorable and 1,000 was favorable, the final total direct material variance will be 800 favorable. Why? Because if in this case 1,800 is a favorable, let's maybe change the color because red on red doesn't go very well. So let's use maybe yellow. No, sorry. Let's use black. So you have 1,800 favorable variance, price variance, and you have 1,000 unfavorable quantity variance. So, and question is, what is total direct material variance? This is a question. It will be 1,800 minus 1,000. So your total direct materials variance will be 800 favorable. Why? Because the biggest number, 1,800, we always subtract the smallest number, and the biggest number keeps its sign. So favorable minus unfavorable will be favorable 800. If it was opposite, that 1,800 was unfavorable and 1,000 favorable, it will be 800 unfavorable, which is going to be 1,800 unfavorable minus 1,000 favorable, which is going to give you 800 unfavorable. I hope it makes sense. So who is responsible for material cost variance? Who is taking responsibility for it? The responsibility can be different managers. For example, production manager can say that because the accountant can say that you use too much materials because of poorly trained workers and poorly maintained equipment. And the production manager can say that I'm not responsible for this unfavorable material quality variance because you purchased cheap materials, so I had to hire more people in order to use more of it. So it's manager's discussion, which we don't study here. It's more managerial accounting and which topic where but as it's part of managerial accounting, this topic, of course, you need to understand that it's a managerial discussion who made kind of mistake and why they had this unfavorable variance. Okay. Here now we're going to talk about labor cost variance. Okay. So instead of price and quantity variances for direct labor, we're going to use rate and hours. Okay. So here you have this extended formula, let's say, and here you have shortcut of formula, which is easier, I think. So what is your rate variance? It's actually your actual rate minus standard rate over actual hours, which means that in rate variance, I need to find out the difference between actual rate and the standard rate in order to find out how much more and how much less I paid per hour. And in efficiency variance, I calculate actual hours minus standard hour over standard price, which means that the price stays constant, standard rate stays constant, but when I need to calculate actual hours and minus standard hours. Okay, this is a formula which you're going to use in order to calculate labor cost variances. We have same example exactly, but here we're going to calculate direct labor variances. So we have direct materials, as you know, we have direct labor. I remind you, we use 1 hour per unit at 16 per hour, and we are given additional information. During the May, GMAX produced 3,500 club hats, working 3,400 hours, and GMAX paid an average of 16,050 per hour. So 16 will be standard rate, 16.50 will be actual rate. Your standard hours will be 1 hour times per unit, so 3,500, and we will need to calculate what will be your actual hours. No, actual hours is given. Sorry, standard hours will be 3,500 and actual hours will be 3,400. Back to this schedule, and as I told you, I created for you, I copied and pasted for you this formulas here, which will give you, although it doesn't work because it's blue, so maybe it's here. So these two formulas. So first we're going to calculate actual your rate variance, and after we're going to calculate our variance, which is efficiency variance. So in actual rate variance, what we're going to do, first of all, we're going to put actual hours, which is 3,400, which was given, times actual rate minus standard rate. So actual rate is 16.5, standard rate is 16. So actually what we have, 0.5 times 3,400, which is equals 1,700 unfavorable. Why unfavorable? Because your actual rate is higher than standard rate. So which means that you're paying actually 50 cents more than you were supposed to pay. Okay. What about your standard efficiency variance? Efficiency variance will be standard rate. Standard rate, if you remember, what's given was 16 over actual hours minus standard hours. Actual hours were 3,400 and standard hours were 3,500. So I was supposed to 16 here. I was supposed to have labor which going to work 3,500 hours because it's a standard hours, but I actually worked 3,004 hours, so 100 hours less. Of course, it's going to be 100 times 16, which is going to be 1,600 efficiency, and it's going to be favorable variance. Okay, so now here we have a case when we have unfavorable and favorable variance. As I told you, if you remember, when the higher variance is unfavorable or favorable, it absorbs the smaller one. So in this case, it's going to be total labor variance will be 1,700 because it's a higher number unfavorable minus 1,600 favorable. So your total cost variance will be $100 unfavorable because you had a higher number for unfavorable. So unfavorable minus 1,600 favorable will give you 100 cost variance unfavorable. This is called labor cost variance. So here we are evaluating labor variances, and we can say that one of the reasons why we have these variances is maybe we are using workers with different skill levels. So what does it mean? It simply means that when you have a high skill worker, you pay high rate, which means that you're paying more salary and they are high skill, and they work faster. When they have low skill, you pay low rate, but they maybe work slower. That's why we can have these variances. Who is responsible for these variances? Of course, responsibility again can be production managers who are assigning the works to labor, and always accountant and general manager or supervisor will ask them a response why they have this, for example, variances. This is the same topic as we discussed before. Just for example, here they can ask to production manager that you use too much time because of poorly trained workers and poor supervision, and he can respond that I'm not responsible for this unfavorable labor efficiency variance because you were one who purchased cheap material, so it took more time to process it. So it's a discussion between two managers, and it's just an interesting process in real life, to be honest. But you need to be aware what is happening after these favorable or non-favorable variances are present. Okay. So here is the last part of this learning objective. We're going to just compute the total overhead variance. And in ATE assignment, you also have to calculate total overhead variance. So we're not going to go in deep in how to calculate variable and fixed, but in general, it will apply to whatever overhead is given. Just you need to calculate simply total overhead variance. Overhead variance calculates the following way. It will be total overhead cost variance equals actual overhead incurred minus standard overhead applied. So if my actual overhead was, for example, 1000 and my standard overhead was 400, my overhead variance will be 600. Okay, so the difference between the total overhead variance and the difference between the actual overhead variance, which was incurred, and the standard overhead applied, which was applied to your overhead, will be difference, and it will give you total overhead cost variance. And we have here example of the same company about this GMAX. So during May, they produced 3,500 club heads working 3,400 hours, and GMAX budgeted 4,000 units. Actual variable overhead was 3,650 and actual fixed overhead was 4,000. So what's going to be total overhead variance? It's going to be your variable overhead plus fixed overhead, which going to be your total overhead, minus standard overhead applied, which was 3,500 times 2. So it was given that they have a 2 per direct labor hour, if you remember from your standard in the previous slides. So what is most important here is that your actual overhead was 7,650 and your standard overhead is 7,000. So your total overhead cost variance is unfavorable by 650. So why it's unfavorable by 650? Because simply your actual overhead is higher than your standard overhead, which explains this reason, and that's why it's unfavorable by $650.